Okay, it's been a little longer than I wanted it to be since the last time I uploaded. Um, in that amount of time, I have well, let's start just by reviewing what we've done so far. So I have not contributed at all to my M1 account. Um, if we look at, I guess the past month in my kind of value portfolio, it's doing very well. That's sort of the play right now. That's what's in favor. So, and also I'm still down on my growth and innovation portfolio. If we look all time, it's down only 4%, but it's up for the week, down for the month, but up a lot today. So it's kind of been all over the place. But I I'm not changing anything. I have just been slow to add to this portfolio because um, well, number one, I'm kind of holding on to cash because I haven't paid taxes yet, so I need to finish our tax return. And once I've done that and know what I owe, I'm going to put the remain. I'll invest any remainder I may have. So I'll have more to show next time, I hope. Um, Something I did in my BlockFi account, I ended up in the last. There was a news article, and I should probably bring that up. So here's an article where the Fed chair, um, Jerome Powell, he called cryptocurrencies not really useful stores of value and says the Fed will move slowly. And someone sent me this, and I kind of thought this was a non-news article, but I think I would point it out because it ended up being beneficial to me at least. So what's funny about it is if you're the Fed chair, you're the head of the central bank, the American central bank. Um, it seems to me that you would approach the idea of like a digital currency or something replacing the current system with, I mean, either disdain or, I mean, crypto is a threat to the current system. I don't think it's as big of a threat as everyone that, like the Bitcoin religious types or the cryptocurrency religious types make it out to be. Kind of the way I see stuff working is this is going to be a slow transition over decades, where the central banks will probably retain a decent amount of monetary power. But that's okay. It can they can coexist, I believe. I don't think you have to have one system stamp out the other, because there are a lot of downsides to the current system, but there are a lot of also kind of beneficial sides. And so here I am jumping into crypto again, but it's kind of where my week has been, like where what I've been thinking about this week. So this article kind of walked through that. His quote was, "They're really speaking about cryptocurrencies. They're highly volatile and therefore not really useful stores of value, and they're not backed by anything," which a friend of mine and I were joking about because it doesn't make any. That's hilarious because no fiat currency is technically backed by anything other than the faith of the federal government. So like the U.S. dollar is not backed by gold anymore. It's just it's backed by our collective trust. So I don't know. I just felt like this was like a non-news thing, but like this news item seemed to drive down the market for Bitcoin, crypto in general. So I loaded up. I had an extra. I should say I'm such a small fry. This is silly. This is all kind of play money, um, that's how I. But on a small scale, this is how I'm thinking. Right. I'm not a big fish or a big whale like some of these Bitcoin guys. But I had, I don't know. Let's see what were my transactions. So if you look at the transactions, I bought like $100 worth, $100 worth, $50 worth, and then interest was paid today, which so I'm taking interest as the Gemini stablecoin, and then I'm choosing when to do my trades. I don't know. It's probably not necessarily superior because it's not automated, but in this account, a majority is in Bitcoin, very little is in Ethereum, and then I have a little bit of the Gemini stablecoin on the side to be able to trade. This is less of a big deal now because BlockFi recently announced that they're doing a kind of an instant ACH transfer. So I haven't tested that yet, but in theory, what they're saying they will do is when you do an ACH transfer, the funds will automatically be available. You cannot withdraw those funds for the 5-day period or whatever, because what they're doing is they're fronting you the money that in these tokens, these stable coins, Gemini, and then you're able to trade immediately. You just can't withdraw, which that seems completely reasonable. They're fronting you the money. They want to see that the money clears, before they let you withdraw. So that's really good news, and it kind of alleviates the problem of needing to have a certain amount of, or a decent amount of stablecoin in here to be able to buy the dip when it does happen. But we had a pretty significant dip this past week, and I took a little bit of advantage of. So that's all thanks to a friend that just pointed it out. He sent me that article, and I didn't think it said anything. It was I very much expected Jerome Powell to say what he said about cryptocurrencies. I thought that was such a strange thing to move the market, but he was saying that they would be slow to implement any kind of digital currency to replace the dollar. I mean, that seems completely reasonable. Everything he said was exactly what you would expect Jerome Powell to say. So I don't know why it moved the crypto markets, but it did, and I took advantage of it. The thing about it was, I guess I'm patting myself on the back, but not really meaning to. But what I'm trying to convey is, traders or investors can be emotional, and they see what they believe to be a bad news headline, and don't think about it from the standpoint of, well, what would you expect him to say? They just base it on what he said, and I guess it kind of depends on the context of the situation. But if I had thought through it, I would have said a lot of people might see this as negative. Maybe there'll be a buying opportunity because it rebounded, within a few days. I kept kind of watching for the bottom, and I think it bottomed around 51,000 something. And also I noticed when you trade, like if this is the market price, if you're trading through BlockFi, you do not pay market price. See how that's over market price, 58.59. So just be aware of that. I assume that could be because BlockFi is taking that premium that they're charging as profit, or they're guaranteeing the transaction to take place by having a higher price here. I'm not really sure. So just something to be aware of that I noted in my recent trades. This wasn't immediately obvious to me, but I want to point it out. Yeah, so let's jump into the week. So here's a clip from a great video by the Swedish investor. Definitely check out his channel. The interesting thing about this clip is that he's talking about the video is about how Charlie Munger made his first $1 million, and he points something out that I think I just found very interesting. So let's take a look.
Also, they've both been wildly successful as stock market investors. A little known fact about Charlie Munger: which we'll talk about more later, is that he operated an investment partnership in the 60s and 70s, which has a greater track record than recently acclaimed investors such as Katie Wood, and even legendary investors such as Peter Lynch.
So yeah, I found this very interesting. He actually, Peter Lynch is legendary, right? And he called her Katie, but Kathy Wood is a very very good investor as well. She's going to have quite the track record, I think. But Peter Lynch, legendary. I had no idea that Charlie Munger managed money and in this sense and had this kind of track record. I mean, that's phenomenal. So anyway, I just thought that was very interesting. So kind of an idea that I took away from this video is that, several things. I mean, Munger had a complex and broad range of knowledge. He was quite the student apparently, and studied a broad range of different subject matters, and he has proven or at least said that he feels that that's been a huge advantage of his. So he was quite the reader, and there's a good quote from him about how I can't remember. It's basically like he's met no successful person that didn't love to read. So that was a very it encouraged me to read more. But what I the kind of the takeaway I wanted to bring up with this is that we as humans have this tendency to think that whatever is happening will continue. So if things are going really well, we have a tendency to think that will just continue forever. And then if things aren't going well, we have a tendency to think that will just continue forever. That's not actually how things go. So I think I am asking you to keep that in mind through the rest of what we're going to talk about. It's definitely, I am catching myself getting too excited or too into the whole crypto space. And so what I will be working on in the coming week probably is how to temper that excitement, because I think it could lead to ruin if you get too intense into a certain area. I'm hesitating to say what I'm saying because I know that that's not always true. You could research something and know it so well and then be very, very successful because you were all in on an idea or a particular investment or whatever. And a lot of people invest that way. Some people invest that way, but I think most people would not be successful doing that because they're not going to put the time and effort that's needed into something like that, myself included. So remain level, at the same time while you're remaining level-headed, listen to this is Michael Saylor from MicroStrategy, MSTR, and he is very bullish on Bitcoin. He famously moved a lot of his company's assets into Bitcoin. And as an aside, you could invest in MicroStrategy and have some exposure to Bitcoin that way if you don't have access to invest in Bitcoin directly. Maybe I shouldn't say invest in. I should say speculate in Bitcoin directly by owning it or using some kind of custodian to trade. So this is actually the first I had ever seen or heard of. I have heard of Michael Saylor, but I have not seen him interviewed. This was one of the first interviews I saw with him from Angelo's interview on his Family Office Association podcast or YouTube channel. So check that one out too if you get the chance. Here's the interview. he's talking about inflation here, and what kind of like what is the real problem regarding inflation?
Yeah, this is where like the MIT education helps. Most problems solved in the real world, like fluid dynamics or thermodynamics or orbital mechanics problems, they're not solved with scalars, with a single number. They're not solved with arithmetic. They're solved with vectors, n-dimensional numbers. That if you're going to describe inflation, you can't describe inflation with a single number, like CPI is 1.8%. Inflation is a vector, which means that I can track the inflation rate of houses. It's 11% this year. I can track the inflation rate of luxury houses in Palm Beach and beachfront property. That's somewhere between, it's 25% in Palm Beach, it's 50% in the Hamptons.
That's crazy to me. I don't know, 11% in 1 year uh, across the board in American real estate, I guess is what he's meaning. And then in more higher end areas, it's much higher than that. That's 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 anyway. That struck me as being very interesting.
I can track the inflation rate of assets like shares of stock or bonds. The inflation rate of the S&P is 39%. So people tell themselves, oh, that's not inflation, that's return. This year, you had hyperinflation in assets, you had no inflation in consumer goods. But rich people tell themselves, I'm a genius, I bought assets that went up 39%. and those consumer goods didn't. Okay, you're captured in your own frame of reference. I can define any market basket of aspirational goods, products, and assets. Then I can calculate the rate at which they change over time. It's a vector. It'll change. It's changing with time. It's changing in space, right? The rate at which real estate in Palm Beach changes is different than the rate at which real estate in the Hamptons changes for good reasons. So once you embrace that idea, then the question is, do you want to live in your parents' basement, watch Netflix, and order Domino's pizza the rest of your life? If so, the CPI is relevant to you. Or would you like to be wealthy or stay wealthy? If you wish to be wealthy or stay wealthy, then the relevant inflation rate is the asset inflation rate. And the best surrogate for the asset inflation rate is either the broad money supply, M2, which expanded 25% this year, or it's the S&P index, which is the most liquid thing. I mean, people said, oh, well, we printed money and there's no inflation. Well, there is. There was instant inflation within minutes in the assets. When you print $1 trillion, the money flows into the assets and the price of bonds goes up. Interest rates go down. That's hyperinflation. In fact, if it costs $1 million to buy a bond that yields $50,000 in interest a year because the inflation or because the interest rate's 500 basis points, when the Fed prints more money, they drive up the price of that bond to 10 million from 1 million. The interest rate is 50 basis points. You've got hyperinflation in the bond. You're just telling yourself a Jedi mind trick. I don't want to buy the bond. This is not the thing I'd want to buy, and therefore I don't care about the inflation. But to the point you made about the dentist, well, what do people want? Do they want a job, or do they want to never have to work again? If what you want is Social Security and you want to be able to retire early at age 40 and paint and live with your family and enjoy your life, you don't want cheap pizza and you don't want free streaming YouTube and Netflix. That's patronizing. I don't want to work till I'm 80 and have cheap YouTube. What I want is to work till I'm 40, buy a bond, and stop working. And if I have to buy an asset. And so the pernicious issue is that the inflation rate of assets was 8% a year from 2010 to 2020. It was 35% from March of 2020 to March of 2021. And if you're 21 years old and you've got a job earning cash, you just saw your assets inflate by 25 or 30%. That's the risk of inflation.
Yeah. So I really like his thought process. He's thinking of not the what we normally refer to as inflation based on the CPI or the consumer price index. He's talking about inflation in different assets. So assets that are not necessarily included in what's determined to be inflation. So monetary policy, if monetary policy is based upon inflation that is measured based on the CPI, he's pointing out that we're seeing inflation in other areas. And I don't know. I just like the inflationary versus deflationary, more fluid thought process than the rigid what is agreed upon inflation or the agreed upon inflation rate. Also like that he referred to it as a vector and was kind of constantly changing. So that was a good takeaway. Let's move on to the other thing that I thought was interesting. Here is an interview on Real Vision where William White is interviewed by Jim Grant. This whole interview is really good because he's talking about central banks and money printing and just bonds. Both of these are big bond guys, and anyway, I just don't have a lot of bond knowledge, fixed income knowledge, and so it's interesting to listen to. Anyway, this is kind of his take on the current situation with the amount of debt that we have and what he sees regarding inflation.
So your question really is, what takes us off that path? I would contend that debt of any sort, if it's unproductive debt, which much of the debt we have is now unproductive debt, essentially narrows the path. And you can fall off that narrow path in one of two directions. And one of them is the debt deflation direction, which is what I think we're probably heading for short term. The other one, you could fall off in the inflationary direction. And which side basically determines how you feel about bonds. Now, I guess my sense of it is that over the course, and I could well be wrong here, okay, it's tipping points all the way, and who knows where they go, when they emerge. I think we're going to fall off on the debt deflation side, in which case monetary easing will continue. The bond rates will continue to stay very low. Whether they will go any further, I guess I have more doubts about that, but I think the likelihood that they will stay quite low for an extended period is reasonably great. Having said that, if the central banks, finding themselves in this situation, say, as indeed many people recommend, okay, that you simply double down on monetary expansion and fiscal expansion, okay, and
he's saying and fiscal expansion, which government spending
and fiscal expansion for the first time, then this combination of a lot of fiscal stimulus supplemented by central bank financing could very easily lead you into a world of fiscal dominance where the expectations suddenly start to shift. And if that happens, then you're into an inflationary world where obviously bonds is the last place that you want to be. So I suspect it will be near-term deflation and longer-term inflation.
I don't know if it's confirmation bias, but near-term deflation, longer-term inflation sounds like something I was thinking. So maybe there's this confirmation bias. I just thought, I don't know. This was a really good interview. You should check it out. Later in the interview, he gives his take on William White gives his take on Bitcoin. You can tell he's kind of not. He hasn't researched it a lot, but here are his thoughts. In general, they make sense.
Great anniversary to rethink the nature of money, and which brings me to the question about modern money, not modern monetary theory, but modern money. And do you put any stock in the progenitors of Bitcoin who say that what is wanted is a finite stock of something that can't be replicated through government intrusion, and something that is truly modern in its ease of like that? And so cryptocurrencies answer some of your concerns about the next thing to happen?
To be honest, I haven't thought as much about cryptocurrencies as I should have done. But I guess the thing that strikes me, and I mean, did a number of years ago, it's all very well to say that in some longer term sense, Bitcoin keeps its value in terms of purchasing power because there's a limited number of things that, so there's a limited number of them that are going to be produced. But we know already, I think there's hundreds of these cryptocurrencies out there. So then the question becomes, have you got something that is in short supply and therefore maintains its value? Or have you got something that is easily substitutable by something else? Which of course is the problem that we've got with money as we define it at the moment, is that there's so many different ways in which you can create stuff that looks like money and acts like money, and which was the death of monetary targeting. I mean, you remember that back in the 1970s.
So monetary targeting is a policy which attempts to directly limit the growth of the total supply of money in the economy. This approach failed in the 1980s when it became clear that the supply of money could not be directly controlled by a central authority. This next clip is another interview on Real Vision with Jeffrey Gundlach. And I found it interesting that he had a similar perspective of what's going on.
Something that was very popular, and it gained a lot of money, a lot of AUM. It was called the permanent portfolio. And it was a very simple concept.
So this permanent portfolio is kind of where I'm leading. He's sort of, well, let's just listen.
I think it had four things, equal weighted. I think it was stocks, high quality bonds, cash, and gold. And I think they were 1/4 each. And it got very successful because there was a window there in the aftermath of the global financial crisis that did really well, that mix of assets. And then it fell on hard times when stocks really got going and the AUM in that particular permanent portfolio mutual fund collapsed. But I think that's a good investment right now. I think we have such a potential tail risk of outcomes, such a disperse potential outcomes, that you really need to have this kind of barbelled asset allocation concept. So I actually think owning 25% gold isn't crazy right now, nor do I think owning 25% cash isn't crazy. They're kind of the opposites. And I also don't think 25% stocks is crazy, because one thing about a potential inflationary environment is stocks can add a zero to their prices. You might not gain in real purchasing power, but you can keep going with a nominal value that has some sort of inflation protection. And the high quality bonds, maybe you're supposed to just have two doses of cash instead of that, because the high quality bonds, the yield is not much different than zero.
There is a possibility. I'm more of a deflationary kind of guy, and even in your dollar scenario, right? It sounds like the dollar goes up, blah blah blah. That's deflationary for a period of time. So the bond part of the portfolio works. Maybe rates go negative in the US. Maybe they go to zero, properly zero, 30 years. And then after that, we get inflation. But that whole portfolio kind of makes sense,
Yeah, I agree with you on that. I am ultimately an inflation fearing person, but in the short term, I do not think there's any inflation. I think what's happened this year is pretty clearly deflationary. And particularly, I think white collar wage deflation is going to be pretty intense. I mean, one thing about work from home is it gives you a different prism through which to analyze your business and the way businesses operate. And I'm pretty sure just about every business owner and CEO has been made aware of ways of working more efficiently, remotely, or maybe they can cost cut by moving some operations to other places. Like my IT department has said to me, there's really no reason for us ever to go back in the office. There's no reason for, because they just live on the 16th floor on our building, off in a corner. You never see them. They're just behind a closed door typing away. They can so easily do that at home. Why do we need that office space? That's clearly deflationary. What about the traveling salesman that can't travel right now? I mean, I think most businesses are probably thinking, do I really need this many traveling salesmen? No. So there's going to be a lot of deflation in the wages of traveling salesmen, and a lot of other middle managers, I think, are going to learn that people have figured out that all they're doing is watching people work that report to them and not really doing any work. And maybe you don't need so much middle management. I think all of this is deflationary. What if somebody moves, they're tired of all the needles on the sidewalk in San Francisco, and they decide they want to go to Boise? Well, you don't have to pay them as much, right? I mean, the cost of living is lower. That's deflationary. And if somebody who felt at risk of losing their job in March and April, they're probably still fearful of an event of job insecurity. I think that they're going to take a pay cut rather than a pink slip. So I do think that there's a lot of deflationary things. And until, weirdly, as Lacey Hunt points out so academically correctly, one weird thing about the deficit is it really isn't inflationary. It's not inflationary until you start actually declaring the liabilities of the Federal Reserve to be legal tender and actually giving money to people, which we're starting to do. That's why I'm ultimately an inflationist. When I used to give speeches, when there used to be gatherings of people, I used to routinely say, I know how to get inflation by 5 o'clock this afternoon, literally. We have an announcement from the Treasury Department that every bank account in America is going to have a $1 billion deposit at 4:59 this afternoon.
And I'll add, though neither of these guys mention it, the deflationary effect of technology and innovation. So Cathie Wood has talked about that there are a lot of deflationary pressures because of that. And I think that's absolutely right. I mean, he did talk about in the work from home, that's technology being leveraged, that's a deflationary pressure. But I thought it was interesting that he was recommending the permanent portfolio. And I think we should remember the context of his recommendation, because he cannot recommend what he's actually doing with his money because he doesn't have the faith in someone else doing what he's doing. And he's an expert, essentially. He considers himself an expert, and he's good at what he does and has lots of experience in that. So he can't just go around necessarily recommending to a novice that they do exactly what he's doing. And I'm guessing that that's really what's happening here, based upon his his non-detailed explanation of what a permanent portfolio is. I do think in what I've been doing with my investing in total, I have been wanting to look more closely at the different components that make up my total portfolio. And then I want to lean into asset classes or asset areas that are sort of out of favor, and essentially start buying deals in asset classes and rotate through some idea similar to the permanent portfolio, probably not quite as simplified. So anyway, these things this week kept me wondering about where I should invest my money in order to protect against all these risks that currently exist. I mean, inflation is more of a risk this year than it was a year ago, or 2 years ago. And there's just no denying that. And these deflationary pressures are definitely a short-term risk as well. Anyway, I'm just slowly shifting toward this idea of something similar to a permanent portfolio. And I'm planning to dig into that maybe in my next video. I think creating something like that gives a lot of advantages, and we'll just have to dig into the details. So anyway, thanks for watching.